Well, hello again and welcome back to the channel. It is Friday, June 6th, and this is your DC-Baltimore real estate and market update. You know, in the last couple weeks, we've seen inventory completely blow through the ceiling that we've seen in the last 5 years. So we are going to talk a lot about that today. I'm going to give you some stories and some perspectives as to why it actually might not be as bad as you think when you just look at the inventory numbers and the rise of inventory. But I'm going to give you different ways of thinking about it and maybe give you some hope if you're a buyer out there that this might actually be the real season that is for you and maybe as good as it gets. And we also have interest rates that have been very wild but trending a little bit higher. We have the stock market that now just crested over 6,000, the S&P today, on the heels of the jobs report, which was better than expected. However, there were some revisions that one could argue the report was not good at all. So definitely some confusion on where we're going with markets. We have the big, beautiful budget battle that according to Elon, he didn't think that you could have a bill that was both big and beautiful. And that has, of course, led to just an epic meltdown between the bromance of Donald Trump and Elon Musk. So, of course, right now, a lot of energy, at least in the DC metro region, everyone is looking for clarity, or maybe we should say confidence, probably both. Clarity in the path forward locally with employment and government spending and jobs. And then obviously that breeds confidence into what to do with your big ticket items like housing. I want to start with the single family home inventory in the DC metro market. Then we'll get into Baltimore next. But what's interesting is you'll see since our last video update, we were just under about 6,000 active units using the 7-day average, and we jumped up to about 6,600. And then just recently, this last week, we kind of rolled over a little bit. If you look at the exact numbers of this week, we are at 6,272. And if you compare that to last year, 4,256. So 2,000 more units of inventory on the market today. It's a 50% increase. But last week and a half ago or so, it was another 300 or 400 units higher. So the question is, what caused this recent little drop? And what I found interesting is that the pending contracts were the same. And we talked about this in our last update when inventory was going up very sharply. We said, I wonder if that's because there are no buyers in the market. And then we looked at this same report and we noticed that, well, there's actually about the same number of buyers. So it must just be more sellers kind of bringing everything out into the market. And the same looks to be the case as far as active pending contracts, new contracts being written are kind of the same. So what caused that drop in inventory? And then I saw this. It was just a massive drop in new inventory. And I'm going to explain why that actually might be an interesting and a positive impact to the local market. Now, one data point, 1 week, you can't judge anything based on that, especially with something as big as housing. Right? You usually look at everything over several weeks to see maybe what's happening with the energy, and then you look over several months to figure out what is the sustainable trend. So while we're talking about this today and the things that I say about maybe, and this could be positive, I want you to also know it's one data point. It's 1 week. So in a few more weeks, we'll do another one of these videos and we'll kind of reflect back on what we talk about today to see maybe what's true. But there's a just massive pullback in new listings hitting the market. And this next chart I found very interesting, still lower than the last 2 years. But then now this chart goes all the way back to 2015. It's a 10-year chart of weekly new listings hitting the market. And if you see where that black line is, it is lower than any other year of the last 10 years. So the reason this is so important is I believe we went through this period of time in the DC metro area, and you could trace it back to the early part of this administration, February, March-ish. You had DOGE, you just had all those executive orders. Oh, we're going to cut 4,000 employees in the Department of fill in the blank and 3,000 and 2,000, cut spending, and everything was about cuts. So if you're local and you're hearing all of that, and I'm seeing a lot of this, we talked about it in the last video, a lot of people started spinning off their properties that were rentals. So that is one part of this, is if we generally operate in spring markets, right, where a lot of people and a lot of transition happens in sort of that March to May, June timeframe in our area, well, if you bought a house a few years ago and you kept that as a rental, those rents are probably rolling around those same points of that time of year, and you're more likely to just say, I'm actually gonna put it on the market now. I don't want the risk of being a landlord in an area where there might be some economic, fragile landscape where people might lose their jobs. I just don't want that risk. So landlords unwinding some of their inventory. The other part is that cycle that we experienced from 2020 to, let's say, mid-23, 4, where someone who moved up and they bought a new house, many of these people were keeping their departing residence as a rental property, right? They were looking at it, real estate always goes up, I've got a lot of cash flow, the interest rate's pretty low. So that was sort of just a natural thing. And it was a very large percentage of my personal clients and at our company that were buying, moving up, and retaining the old house as a rental. That has also changed. I've noticed more of our move-up buyers this year say, I don't want to keep it as a rental. So you had landlords unwinding some inventory. You have natural buyers that now want to sell their place. And then you just have the fear of everything that has been created in the market with DOGE, government cutbacks and spending, that leads to people trying to move a little faster, right? I want to get this on the market really quick because I think bad things are going to happen. Let's call that the herd mentality, where all of a sudden the energy was all moving in this one direction. I don't know, if I'm a real estate agent and I'm looking for listings, I'm probably telling a lot of people now is the best time to list, get ahead of it. Let's go. There's just too much uncertainty. Let's go. Let's get it on the market soon. Let's try to beat the price reductions if they happen. So there's a sales aspect to it. There is a local economic worry aspect to it. There is a financial piece of people not wanting risk, being landlords, right? So there's all those things melting together that quite possibly could have led to this big increase in inventory. We may have pulled several months of inventory forward, and yet these numbers right now look awful. And what if we then start seeing it smooth out and get more normal from here? So I want to show you something else that I found pretty interesting. As I went back and I started thinking, like, when is the last time that I've had the same level of conversations that I'm having where people have the ability to buy, they want to buy, but they don't have the confidence to buy? So that last period of time for me was really all of 2018, and specifically peaking in late 2018. Now, that was, just to take you back in time, that was the last time that Trump and China were fighting over tariffs. I think it started early, like March, April that year. And then I think it ratcheted up a little bit. The Fed had a tightening cycle. I think they raised prime rate 3 times that year, I believe. And the market started feeling like the Fed was too restrictive. The economic signals were starting to soften. And then mortgage rates were peaking. I think a lot of condo rates anyway, were probably in the low to mid 5s. Maybe people with big down payments were in the super high 4s, which back then sounded high, but today I'm kind of jealous. So here's what I want to show you. If you look at this chart, this is just the Freddie Mac average interest rate chart. The blue line's the 30-year fix, so we'll just kind of focus on that. But you'll see in January of that year, interest rates were at 3.95. But by the end of the year in November, they had jumped 1% to 4.95. Now, right after that, the stock market crashed about 20%. The Fed pivoted. And 2019 was a pretty good housing year, and values actually popped quite a bit. Now, the reason I want to point this out is in late 2018, there were many articles and there was just really bad energy in the market. People just didn't want to buy. And I wound up helping a lot of people in the early to mid part of 2019. They eventually bought, and the prices they were getting were 5, 10, 12% higher than what they could have bought for in 2018. Now, I know, especially if I put this on X or something, I'm going to get trolled for saying this. Like, now might actually be the best time for you to buy because there's an argument that with everything going on right now, it might just be the herd running into this emotion of now is bad, don't do it, right? So in February, March of this year, when stocks were crashing, the narrative was the economy is going to fall apart, prices are going to skyrocket, meaning inflation's going to go up, the cost of goods of everything are going to rise, stocks are crashing, and a lot of people sold, where really the smart money was buying in that moment. And then now here we are a few months later and stocks are almost back to the all-time high. Now, we could debate just everything that happened and how people feel about the messaging of the administration and just how everything was self-fear, doom, gloom, and then walk it all back. But I want to touch on that too, because the self-fear, doom, the world's ending, everyone gets this one mindset, and then it all gets walked back. My point to why right now might be the most interesting time is the listings we might be seeing today could be a direct result of the fear that has been created in the market. But if the walking back of everything, like we're seeing the walking back in all the tariffs, like we're seeing the walking back of Doge, right? Think about it. In February and March or April, it was all about cut spending. And now it's about spend. You have, countries around the world dropping rates, adding liquidity. Our Fed is one of the only ones sort of really digging in and staying high. We have talks of bank deregulation happening in the summer, something about banks being able to buy and hold more treasuries and not have it negatively impact their books. I forget exactly how all that works. That in itself could lower interest rates. But what if all of this stuff just keeps getting walked back? What if it was all just a bunch of noise? And now all of a sudden you fast forward maybe 3, 4, 5 months and everyone gets clarity in their job. Everyone then gets confidence to buy. And then they look back and they're like, man, I should have jumped in when inventory was spiking. I should have jumped in when there was fear in the market. Now, the other side of this story is that things could roll over, right? What if everything goes the negative direction? Looking at what's happened recently, looking at stock market behavior at the moment, granted, in 2008, stocks rallied all the way back to all-time highs again, or in 2007, right? It started crashing and going up and down and lots of volatility. We went back to all-time highs before rolling over again. So maybe that happens. It feels like there's a lot of misguided fear right now in real estate. There is still an affordability issue with interest rates. So I don't want to act like that's not part of the problem. But in 2022, if you remember, late 22, the world was also ending and inventory was also spiking and no one was going to buy a house because no one could afford it and prices were going to drop. Well, what happened in 2023? Prices went up. What happened in 24? Prices went up. So, I want to just make everyone realize that there are these fearful points in time. 2018 was one of them. 2022 was another. And here we are in 2025, another. And you just have to look at those data points and you have to use your eyes and your ears and not what you read. I think that's the other big problem is so much of what we consume these days, the negative headlines are ultimately what sell the most. And then we go out and talk to all of our friends and everything's still fine. And everyone's still spending and everyone's still going on vacation. So I'm curious. Now, I haven't seen a lot lately, in all honesty. Last 2-3 weeks, I've been deep in this AI hole of just creating a bunch of stuff for business and then kind of working through my kids with, college season coming up and recruiting for lacrosse and just all this stuff. So we haven't eaten out at all. We're not traveling much this summer other than lacrosse stuff. So I'm a little disconnected at the moment as far as what people are doing and how they're spending and living. But drop in the comments, what you think. Are the wheels coming off the bus? Are restaurants more empty than you're used to seeing? Are your friends not traveling? Do you see fewer new cars? Are people really pulling back or not? My feeling based on conversation is no, but I'm curious to know what you think. So let's get into a couple other things I wanted to highlight. In late 2018, I was telling you about that whole everything stalled, and then 19 was amazing. So these reports are from GCAR. I'd sort of pulled out Washington, D.C. and Montgomery County. That's just the easiest two charts I could find. And you'll see in 2018, We went from selling almost 700 single family homes the year prior, and it dropped all the way to 581, right? So it's a huge drop in units, although prices were a little stable. But then fast forward to 2019, huge jump. We went right back to all-time high in units and all the way up to a high in average price. There is a really good feeling that I have that we are reliving this same exact scenario. And if you look at Montgomery County, same thing. We had only 778 units then in 2018, and then it jumped to 1,033 the year later, a 50% increase in sales with a nice little jump in prices. Obviously, you look at that compared to where we are today, it's disgusting. Now, the Baltimore market, we always say, is not moving sort of step by step with DC. The dynamics of sort of the drama in DC doesn't quite transfer over into the Baltimore MSA. The government jobs that are generally in the Baltimore MSA are mostly defense, and I feel like defense is kind of hanging in there pretty good. But you can still see that we have more active inventory right now compared to where we've been. Let's see, we have 2,200 units on the market today. So that's about, again, 50% increase. So percentage-wise, still up a lot, but from an actual unit total, not so much. Now, the pending contracts are still in lockstep with the prior years. So not much change there, but still that same thing. We wound up seeing just this cliff of inventory fall off. I'm really curious. I know there's some seasonality in that with Memorial Day, but I really can't wait to see what this looks like next week. Is it going to be smoothed out because of the Memorial weekend, or was it truly everything I just said, where everyone just bum rushed the market with all their listings, and now we just see all of those get gobbled up and we fall back into more of a mainstream? You see, same thing. The lowest amount of inventory in 10 years, also in the Baltimore MSA. So this is the stock market. You know, I always like talking about the stock market because it is definitely one of the drivers of buying houses. So you have multiple segments of people and how they operate in life. Generally, first-time home buyers, stock market's like a little bit important. Maybe your 401k, your ability to borrow from that or save. You just feel more confident in life when you just see that growing. You know, maybe you don't have a lot of liquid net worth, but you're cool with that because you have your house growing for you. And there we are, stock market cracked over 6,000 today for the first time since early this year. Now, it'll be curious to see if this has legs. It feels like it does. Now, on the interest rate side, I think the average went up to 6.93 today. So it was not a fantastic week over the last few days. You know, we actually had some promise of low rates, combination of two things. We had soft economic data. I think it was non-manufacturing. ISM came in recessionary territory. Under 50 is sort of the reading. Above 50 is expansionary. Under 50 shows recessionary stress. And I think it was like 49.9 or something like that. And there were other, jobless claims were a little bit higher. And then, of course, the battle between Musk and Trump, and sort of Musk bringing this big push towards fiscal discipline. And everyone started wondering, is that going to be what cracks this big, beautiful bill? In all honesty, there's an argument for, if you have that bill be a lot smaller, that rates could actually get better. So there is an argument that more deficit spending is just not good for rates. Now, of course, that all this morning just sort of evaporated. I think people looked at the jobs number, the wage component was a little higher. There are definitely lots of people that are looking at the guts of that jobs report and the revisions and saying it's not nearly as strong and they don't believe the numbers. But honestly, throughout the whole last administration, every single jobs report, people said the same thing. So, take that for what it's worth. But the 10-year bond keeps moving up. We're back up to about 4.5 right now. And mortgage rates are just right under 7%. I will say, I'm doing a video. Make sure you follow the channel. It'll be out next week on loan-level price adjustments and why interest rates can be so different. Are you a first-time home buyer or not? What are you buying? How much are you putting down? What type of property is it? And you'll see today interest rates as low as, let's say, 6.3-ish, 6.25. But then you'll have some people get rates of 7.25. So it just depends on their whole matrix. And I think that's it. I would say the last thing I would talk about is when you think of this big, beautiful budget bill, and how that might influence interest rates moving forward. I will let you know that there's an interesting concept where right now a lot of analysts, or at least people in Congress, they're shifting the talk from total deficit and total dollars, right? Like, oh, it's $35 trillion of deficit. And you'll hear a lot of people now talk about debt to GDP. And they're trying to say, well, right now there is debt, and we have a lot of it, and we're asking for more debt. But as a percentage of GDP, what if GDP were larger? What if all of these tariffs work? It brings back some manufacturing. What if we unleash the economy with tax cuts and whatever, and all of a sudden you bring in a lot more revenue and you're producing more as a country, your GDP goes up. All of a sudden that debt becomes way more manageable. Right? So debt to GDP. It made me think of an important concept in housing that I think is important. It doesn't get talked about often enough, which is a lot of times when you buy a house, think that there's no repairs for a second, but there usually are. But the day you buy it, it tends to be the most expensive that it will ever feel for most people. Certainly not for everybody. But let's assume all things are equal in life, and as you work longer and you age, your income goes up over time. Well, that mortgage is locked in, right? So once you buy that house and you get a 30-year mortgage, the only thing that can change year to year would be your property taxes and your home insurance, which are small incremental increases. But at the same time, wages generally go up over time while that payment is fixed. So that is sort of the argument right now in Congress is focus on debt to GDP. Let's just grow GDP. If we do that, the debt becomes manageable. So if I'm struggling right now paying bills, it's like, oh, I just need to make more money, right? I need to go out and bring in more revenue into my household. So that's sort of the argument. Unleash all this stuff, take on more debt so that you can make more money. And it was just an interesting tie to housing where you're locking in debt and over time likely making more, that debt becomes more manageable. So anyway, I hope you enjoyed this week's update. I know I rambled a lot, talked pretty fast, but any questions that you have, any comments about what I've said, any disagreements, more importantly, definitely throw them down in the comments. I love talking about this stuff all day. And until next time, enjoy your summer.